Let's get back to the mixed messages we're getting on Wall Street right now. As earnings season moves into full swing, S&P Capital IQ is expected to see the slowest growth in 3 years overall. And when it comes to the help of monetary stimulus, one of our next guests, Keith Springer of Springer Financial Advisors, says that that's all that's driving this market right now. And he feels we're starting to see a crack in the armor on that.
We did expect this. We expected the slow earnings period. So what is there to depend on in today's market? We bring in our panel along with Keith Springer. We've got Carol Roth, author of The Entrepreneur Equation, Michael Pento of Pento Portfolio Strategies, and our own Rick Santelli. Rick Santelli, let me kick this off with you. What are you seeing in terms of stocks, money moving out of equities in some areas here, moving into fixed income?
Well, you know, many traders down here think that this is going to be a rough and bumpy earnings season and rough and bumpy guidance. But they believe that the stock market has a bit of immortality thanks to the Fed. In terms of interest rates, they believe if the actual data continues to improve in a real way, like some of the housing data points, some of the ISM points, that we will indeed see an appropriate rise in rates. And that threshold seems to be about 2%. So we're about 20 basis points away. They do see some optimism, though.
Is that why you think the yields have gone up as much as they have in the last week for the Treasuries, especially that 10-year?
I think it's 50% Europe and 50% the better data is reflected by higher equities.
All right, Keith, what about we seem to be feeling optimism here. We got the housing start number better than expected. Housing has been a bright spot. The financials have had, mixed results here so far. But here we sit at 4.5-year highs for the markets. You feel this is due to the Fed, though, right?
Well, you've got to love the printing press. They keep printing money, putting money in. We've had a sea of liquidity. The good thing is we've got such negative sentiment. We've had earnings expectations beaten to a pulp. It's not really hard to beat these expectations, so every time a company comes in with mediocre returns, everybody gets excited. The housing starts were nice, but let's remember the banks are sitting on millions of homes they're allowing people to live in for free so they can take care of the lawns. This is largely stimulus-driven. Once we get the law of diminishing returns, eventually it's going to wear off. The QE1 we had about a year. QE2 we had about 8 months. Maybe we can get 3 or 4, maybe 6 months out of this, but even trees don't grow to the sky. Investors need to be careful here. Invest for need, not for greed, and just not put everything on the table.
And that's why I think we are seeing a bit of a breather actually today in terms of equities here. Michael, do you buy into the housing numbers today? Do you want to look at those numbers and say, okay, we have bottomed, things have turned in housing, you want to put money to work?
Well, look, let's look at the facts here. 95% of all new mortgages are controlled by the government. Do you know that 40% of those mortgages are now guaranteed explicitly by the FHA? And that's with 3.5% down. And the entire economy is addicted to these fictitious interest rates. They are at 0%. Interest rates are going to rise because of the overwhelming amount of debt that we are issuing and because of the inflation we are creating. And when that occurs, you're going to wipe out the housing market, bounce back, and we're going to go right back into another leg down in housing and the economy.
Yeah, you're not real happy about what's going on right now.
No, not at all.
Yeah, Carol, I know you feel a lot of the data are what you would call schizophrenic right now, right?
I absolutely do. I think the housing data is completely schizophrenic. We have slow growth. Nobody has jobs. Who's buying these houses? People can't afford the mortgages. They can't even qualify for the mortgages. So I think that this is driven a lot by investors and not by the average consumer. So I'm kind of with the panel here. I feel like this could be a potential additional asset bubble, and I'm just not buying it.
Yeah, boy, we got a tough crowd with us today here, huh?
Yeah, we really do. And in terms of this market here, what do you want to do in the face of all of this? Do you want to put money to work or sit on the sidelines going into year end?
You can't put money on the sidelines. What are you going to do? Buy a treasury bond and get killed and a negative real interest rate? You have to put money to work, and you have to put it into those things that the government cannot create by fiat, and that's hard assets.
Okay, Keith, what are you buying here?
Now, you've got to buy yield here. You can buy some hard assets, but we're in a deflationary environment. We've got to remember, we don't see inflation even though the government is printing.
Don't go to the grocery store.
Nah, but assets are being destroyed faster than the government can inflate with. You got to buy yield here. You can find good yields. You can find MLPs and preferreds. There's plenty of places. If you don't need all the risk of the market, don't take it. It's what we do for our clients. We've got to remember, we're in a deflationary environment for a couple more years. That's why we're not seeing any inflation, even though we're printing money.
Hey, look, can I just say something?
change.
Look, I hate to interrupt, but have you looked at the money? I know, but that's kind of how I do things. But I'm sorry. I can't help who I am. But look at you. Look at M2.
Look at this.
M2 is growing. M2 is up 7% year over year. Money supply, the largest aggregate still kept by the Fed, is up over 6% year over year and growing at 8%. So how could that be deflationary, sir? Where is that money going?
we see any inflation?
Oh, it's going into the bond market, the biggest bubble in history.
All-time high.
Yeah, what was that?
Are you seeing any inflation?
What was
What'd
that,
you say, Rick Santelli? What'd you say about CPI?
CPI index yesterday is at an all-time high level.
Thank you, Mr. Santelli. Thank you.
Carol, bring some a modicum of decency here to this conversation here. Settle us down, would you?
That's not fair.
Well, I don't know that I'm the right person to do that, Bill.
Break the ties. Are you worried about inflation or deflation right now?
I'm more worried about inflation right now. I think that you're going to see it in food. I don't think gas prices are going anywhere. And a sector that I particularly hate right now is the restaurant sector. I think that it's had a really good run, and it's going to be really hard for them to keep up those comps in the face of the rising food costs. So I'm on the inflation bandwagon here.
So would you be buying hard assets?
You know, right now I'm actually taking a breather. We've done quite well for the year, and so I'm taking a little bit of a breather, taking in all of the information. If you're somebody who is churning your portfolio, lots of volatility to do that, but I'm more of a long-term investor, so I'm sitting this one out for a few days, Bill.
All right. Thanks, everybody.